Gold just fell nearly 30%. Silver collapsed over 55%, and almost everyone called it the end of the rally. But the charts tell a different story. One institution just quietly changed the rules of the bond market, and the last 3 times this exact pattern appeared, gold didn't just recover. It exploded past every previous high. Welcome back to Currency Arc Insight, the channel dedicated to decoding the hidden forces shaping the global economy, protecting your wealth, and preparing you for what mainstream financial media refuses to say out loud. If you're new here, subscribe and turn on notifications, because what we're about to break down today could change how you think about your entire portfolio. For 6 months, gold and silver put professional patience to the test. After one of the most explosive precious metals runs in modern history, spanning from 2024 into early 2026, both markets entered a deep, and for many investors, unsettling correction. Gold shed nearly 30% from its peak. Silver fell even harder, losing more than 55% from top to bottom. For newer investors, who had only ever seen these metals climb, the decline felt like confirmation that the bull market was over. For those who understood market structure, it was something else entirely. It was overdue. No asset class rises in a straight line forever. When gold and silver posted the gains they did between 2024 and 2026, they were pricing in years of monetary stress in a matter of months. A pullback was not a warning sign. It was the natural consequence of a market that had moved too far, too fast. The real question was never whether a correction would happen. It was how deep it would go and what would come after. Throughout the summer, both metals tested their lows more than once. Twice, maybe 3 times, sellers pushed to force a breakdown below key support. Each attempt failed. That detail matters more than most retail investors realize. In market structure, a level that repeatedly rejects lower prices despite sustained selling pressure is not weak. It is being defended. Institutional capital, patient capital, was stepping in at those levels and refusing to let the market break down further. Then the rebound began. And this is where the story shifts from simple technical bounce to something with real structural weight behind it. As gold and silver started climbing off their summer lows, the fundamental backdrop did not just stay supportive, it strengthened. This is the detail that separates a dead cat bounce from the early stage of a genuine bull leg. Price recovering on its own means little. Price recovering while the underlying macro conditions actively improve means a great deal more. The clearest signal came from the bond market, a place most retail investors ignore entirely, but one that professional money watches obsessively. The yield curve, specifically the spread between 2-year and 10-year Treasury yields, began steepening in recent months. A steepening curve is not a neutral signal. It typically reflects one of 2 things: rising inflation expectations or growing economic pessimism about the path ahead. In the current environment, there's a strong case that both forces are at work simultaneously. And historically, a steepening curve of this kind has been bullish for gold because it signals exactly the kind of monetary and economic instability that drives investors toward hard assets. This is the environment institutional investors have been positioning for. Not a short-term trade on a weak jobs report or a single inflation print, but a structural shift in how capital views risk, debt, and the long-term purchasing power of fiat currency. The correction cleared out weak hands and speculative excess. What remains is a market rebuilding on a stronger foundation, with real fundamental pressure now reinforcing the technical recovery. For investors who understand how these cycles have played out before, this combination, a sharp correction followed by a fundamentally supported rebound, is not a reason for caution. It is historically the setup that precedes the next major leg higher. The correction was never the end of the story. It was the reset the market needed before its next move. What happened next in the bond market did not just support this recovery. It may have confirmed where the entire system is headed. That development and what it signals about the future of interest rates is where the next part of this analysis begins. Every major turning point in monetary policy leaves a trail before it becomes official. Central banks and treasuries rarely announce a shift in direction outright. Instead, the signal shows up first in the bond market, quietly, in the mechanics of who is buying what and why. Right now, that trail is pointing toward one of the most consequential monetary developments of the decade, and it explains exactly why gold and silver have found such firm footing beneath their recent rebound. The starting point is the yield curve, specifically the spread between the 2-year and 10-year Treasury yields. For much of the past several years, this spread has been a quiet barometer of economic confidence. When it flattens or inverts, it typically signals that investors expect the economy to weaken and interest rates to eventually fall. When it steepens, the message changes. A steepening curve tells investors one of 2 things is happening. Either inflation expectations are rising, or economic pessimism about the years ahead is deepening. In many cases, it reflects both at once. In recent months, that steepening has been unmistakable. The gap between short-term and long-term yields has widened, and that widening has coincided directly with the recovery in gold and silver prices. This is not a coincidence. A steepening curve driven by inflation concern or economic uncertainty is precisely the environment in which precious metals have historically thrived, because it signals that the value of holding cash in long-duration bonds is eroding in real terms. Then came the development that turned a quiet signal into a headline. Treasury Secretary Scott Bessent announced that the government would begin actively purchasing long-term bonds, specifically 10-year and 30-year maturities, in an effort to cap how high those yields can climb. On the surface, this sounds like a technical, almost bureaucratic policy adjustment. In practice, it is one of the most significant monetary developments investors will see this cycle. Technically speaking, this is not yet full yield curve control, the formal policy where a central bank commits to defending a specific yield ceiling by any means necessary. But many analysts are already calling it a soft form of quantitative easing, and the distinction matters less than the direction it reveals. Whatever label is used, the effect is the same. The government is stepping into the bond market to suppress long-term interest rates, because the alternative is unacceptable. And that is the deeper story here. The United States, along with corporations and households carrying record debt loads, cannot function under sustained high long-term interest rates. The math simply does not work. Every basis point increase in long-term yields adds enormous pressure to interest payments on existing debt, to mortgage markets, to corporate refinancing, and to the broader cost of capital across the entire economy. A financial system this leveraged cannot absorb a genuine, sustained rise in long-term rates without triggering serious instability. This is why Bessent's announcement should not be viewed as an isolated policy tweak. It is a preview, a small, controlled sample of a much larger intervention that is almost certainly coming. Yield curve control, in its full and formal form, is widely expected to become policy in the years ahead, not because it is the ideal solution, but because the alternative, allowing long-term rates to rise unchecked, poses a greater systemic risk than the intervention itself. For gold and silver investors, this context transforms the current rally from a simple technical recovery into something with real structural staying power. Markets do not need to wait for yield curve control to become official policy to start pricing in its consequences. The direction is already clear and capital is already positioning accordingly. Every step toward suppressing long-term rates through artificial buying is, by extension, a step toward currency debasement, and hard assets like gold and silver are the direct beneficiaries of that dynamic. This is more than a technical bounce built on oversold conditions. It is a fundamentally supported move, reinforced by a monetary authority that has effectively signaled its own long-term intentions. The bond market rarely lies, even when policymakers choose their words carefully. And right now, it is telling investors exactly where this cycle is headed. To understand just how far that trajectory could extend, the next part of this analysis turns to history itself and what previous major gold recoveries reveal about the scale of the move that may still lie ahead. Markets rarely move in ways that are entirely without precedent. Every major recovery leaves a pattern behind, and for investors willing to study those patterns closely, history offers something rare, a rough map of what may still be ahead. When it comes to gold's current recovery, that map points toward a target that sounds almost unbelievable at first glance, until the historical comparisons are laid out in full. To understand where gold could be headed, it helps to look at three previous major corrections and their subsequent recoveries, 1973, 2006, and 2008. Each of these periods followed a similar structural pattern to what markets are seeing today. A powerful bull run, followed by a sharp correction, followed by a strong and sustained recovery that ultimately pushed gold to new highs. When these historical recoveries are scaled and overlaid onto the current decline and rebound, they produce a striking projection. Using an average of the 2006 and 2008 recoveries, the data suggests gold could reclaim its previous highs by the end of September. Widening the comparison to include the 1973 recovery, one of the most explosive gold rallies in history, pushes that timeline slightly further out, closer to the end of the year. Either way, the message is the same. Based on these historical analogs, gold is not just recovering. It is on a trajectory that could carry it back to, and eventually beyond, its previous all-time highs within a matter of months. At the time gold closed, the most recent week, it was sitting just above 4,600. Reaching the prior closing high near 5,400 would require another 800 points of upside. Reaching the intraday high near 5,600 would require closer to 1,000 points. That is not a small move. But when measured against the pace of previous historical recoveries, it is well within reach, on a timeline of months, not years. This is where sentiment data adds another layer of confirmation. Bank of America's monthly fund manager survey, one of the most closely watched institutional sentiment gauges on Wall Street, showed a meaningful shift. The prior month, only a net 6% of surveyed fund managers considered gold undervalued. In the most recent survey, that number jumped to a net 16%. For context, current readings are approaching levels seen near the October 2-to-8 bottom, one of the most significant buying opportunities in modern gold market history. This is not retail enthusiasm. This is professional institutional money beginning to shift its view on gold from expensive to attractive. A second data point reinforces the same conclusion. The share of total ETF assets allocated specifically to gold. This metric strips out noise and shows, in real terms, how much conviction institutional and retail capital collectively have in gold relative to other asset classes. Compared to both the 2000s bull market and the past decade, current allocation levels remain historically low, suggesting there is significant room for capital to continue rotating into gold before anything resembling euphoria or excess is reached. Layering price action, historical recovery patterns, and sentiment data together paints a coherent picture. This is not a market driven purely by speculative momentum. It is a market where professional sentiment is shifting. Allocation remains historically light, and price recoveries are tracking closely with prior major bull market comparisons. When these three factors align, they have historically marked the early to middle stages of a much larger move, not the final stages of an exhausted one. Based on these combined historical projections, a realistic near-term target sits between 4,800 and 5,200, representing the next major resistance zone gold will need to clear. Beyond that, extending the same historical recovery curves further into 2027 and early 2028 points toward a considerably higher target, with some projections reaching as high as 7,000. These are not arbitrary numbers pulled from speculation. They are derived directly from how gold has behaved after previous major corrections of similar depth and duration. Of course, no historical comparison guarantees an identical outcome. Markets are shaped by unique conditions each cycle, but when the fundamental backdrop, described in the previous part of this analysis, aligns this closely with historical recovery patterns, it strengthens the case considerably. This is not simply a hopeful narrative. It is a convergence of technical history and macroeconomic reality pointing in the same direction. While gold's path forward is becoming clearer, silver tells a different story, one shaped by its unique role as a leveraged play on gold's movements. Understanding why silver has lagged behind and what could trigger its own explosive catch-up move is where the next part of this analysis turns. If gold is the signal, silver is the amplifier. For decades, silver has behaved as a leveraged play on gold, meaning that when gold moves, silver typically moves further in the same direction, but usually with a delay. Silver does not lead these recoveries. It follows, often frustratingly slowly at first, until gold clears a critical resistance level and gains real momentum. Only then does silver begin to catch up, and when it does, the move tends to be sharper and more explosive than gold's own advance. This pattern is playing out again right now. As gold has recovered off its correction lows, silver has followed, but with the lag that has defined this relationship for generations. To understand why this lag matters and what it signals about silver's next move, it helps to look at how silver has behaved after its own previous major corrections. Three historical periods offer useful comparisons: 1974, 2008, and 2011. Each followed a sharp decline similar in scale to what silver experienced over the past 6 months. The fit between these historical patterns and the current setup is not identical across all three. The 2011 decline marked the end of a secular bear market. The 1974 recovery saw silver move sideways for several years before its next major advance, but the 2008 comparison stands out as the closest analog. That period saw a sharp crash followed by a strong cyclical bull market recovery, a structure that closely resembles what silver appears to be tracing out today. When these three historical recoveries are scaled onto the current decline, the results are striking. The 1974 recovery, mapped onto today's scale, rallied to roughly 90. The 2011 recovery reached a similar level, nearly 90. The 2008 recovery climbed just above 80. Silver is currently trading near 70, which means, based on these historical comparisons, this recovery still has meaningful room to run before it even approaches the levels reached in prior cycles. The near-term picture, however, requires patience. Silver is currently approaching a key resistance zone around 70, reinforced by the 200-day moving average sitting just above that level near 71. This is significant technical resistance, the kind of level that has capped rallies before. Beyond that initial resistance, a stiffer ceiling sits closer to 77, followed by additional resistance in the 80 range. The critical relationship to understand is this: silver's ability to clear these levels is directly tied to gold's own progress. As outlined in the previous part of this analysis, gold faces its own resistance zone between 4,800 and 5,200. Until gold decisively breaks above that zone and builds real momentum, silver is likely to face a difficult time clearing its own resistance near 70. But once gold does break through, historical precedent suggests silver would follow quickly, potentially pushing towards 71, then testing the tougher resistance at 77 and eventually 80. This lagging relationship is not a weakness in silver's setup. It is the mechanism through which silver's biggest moves have always occurred. Investors who understand this dynamic recognize that periods where silver appears to stall while gold advances are not signs of silver losing strength. They are the coiling phase that has historically preceded silver's sharpest catch-up rallies. When silver does break through resistance, the leveraged nature of its relationship to gold tends to produce moves that outpace gold's own percentage gains by a wide margin. For long-term investors, this creates a specific kind of opportunity. Silver at current levels is not simply following gold passively. It is building the technical and psychological base required for its next major advance. The resistance levels ahead are well defined, the historical precedents are consistent, and the fundamental backdrop described earlier in this analysis, a weakening dollar, rising inflation expectations, and a bond market signaling deeper monetary stress ahead, applies just as directly to silver as it does to gold. The metals themselves are only part of this story, however. The clearest evidence that this recovery has real institutional backing is not found in gold or silver prices directly, but in how the companies that mine them are beginning to behave. That shift, and what it has historically signaled about the stage of the cycle markets are entering, is where the final part of this analysis turns. Price charts tell part of the story, but when it comes to identifying where a market cycle truly stands, one of the most reliable signals does not come from gold or silver themselves. It comes from watching how the companies that mine them behave, because mining stocks tend to move with far greater conviction and far greater volatility than the underlying metal. And right now, that signal is flashing clearly. The relationship to watch is gold mining stocks measured against gold itself, a ratio that strips out the noise of the metal's own price action and isolates whether capital is choosing to bet on the miners specifically. For 13 years, this ratio had been building what can only be described as a long, grinding base, a period where gold stocks consistently underperformed the metal, even during rallies. That kind of extended underperformance typically reflects deep skepticism, capital avoiding the risk and operational complexity of mining companies in favor of simply holding the metal. That 13-year base has now broken. In just the past few weeks, the ratio has staged a sharp V-shaped recovery, closing at a new 13-year high on both a daily and weekly basis. This is not a minor technical development. A breakout of this magnitude, following a base this long, has historically marked the beginning of a much larger rotation, one where capital shifts away from simply holding the metal and starts flowing aggressively into the equities tied to it. This distinction matters enormously for how the next phase of this cycle could unfold. When gold stocks begin outperforming gold itself, it typically signals that professional and institutional capital is gaining confidence, not just in the metal's price, but in the broader durability of the move. It is one thing for a metal to rise on macro uncertainty. It is another for investors to commit capital to mining companies, businesses with operational risk, labor costs, and geopolitical exposure, because that requires genuine conviction that the underlying trend has real staying power. Supporting evidence comes from market breadth data, specifically the percentage of the top gold mining stocks trading above their key moving averages, the 200-day, 50-day, and 20-day, along with the number of stocks hitting new 52-week highs. In the weeks leading into this breakout, this breadth data showed exactly the kind of oversold extreme typically seen near major bottoms. As the recovery has taken hold, that breadth has flipped dramatically, with a large share of these stocks now trading above all three major moving averages simultaneously. Historically, breadth readings this strong have appeared at pivotal moments, including after the 2016 low and following the initial recovery after the 2020 pandemic crash, both periods that preceded substantial multi-month rallies in the sector. It is worth noting that similarly strong breadth readings also appeared briefly in 2022 and 2023, periods that turned out to precede short-term peaks rather than sustained rallies, because those moves occurred within a broader bear market for the sector. The critical difference today is context. The current breakout is occurring alongside the fundamental and historical tailwinds described throughout this analysis, a steepening yield curve, a Treasury actively intervening in the bond market, improving institutional sentiment, and historically low ETF allocation. When strong breadth data aligns with a genuinely improving macro and fundamental backdrop, rather than occurring in isolation, it has historically signaled the early to middle stages of a bull market, not its exhaustion. Taken together, the picture that emerges is coherent and consistent across every layer of this analysis. A necessary correction cleared out excess and reset the market, a steepening yield curve, and direct Treasury intervention. In the bond market, signaled deeper monetary stress ahead, stress that has historically been highly supportive of precious metals. Historical recovery patterns from 1973 to 6 and 2008 suggest gold still has significant room to run, with silver positioned to follow and potentially outperform once gold clears its next resistance zone. And now, the decisive move in mining stocks relative to gold itself suggests that professional capital is no longer just watching from the sidelines. It is actively positioning for what may come next. For investors who have watched previous cycles unfold, this combination of signals, technical, fundamental, and sentiment-based, arriving together, has historically marked one of the more consequential moments to pay close attention. The correction tested patience. What comes next may test whether investors recognize the opportunity in front of them before it becomes obvious to everyone else.